Okay, I am told we have a speaker in the room. Is such a fact true, Kate?
Yes, I believe we've got Mike Hamilton here.
Okay, Mike, how are you?
Hi, John. I'm here. Can you hear me?
Yeah, where are you broadcasting from today?
I'm talking to you direct from London, from sunny London.
What part of London?
The South Bank, near London Bridge.
Yeah, I know it quite well. I lived in London for 10 years.
Oh, right.
And actually worked in the Swiss Bank building, which isn't the Swiss Bank building anymore, but it's right on the river next to London Bridge. So that used to be my view from my corner office at Swiss Bank Corporation.
I don't know if you've been back to London very recently, but London's gone through a heck of a change in even the last 10 years.
And haven't we all? Let me just give you a
Yeah.
quick introduction. Mike Hamilton is from Trade the Easy Way. He started investing in UK stocks using a value system in 1984 part-time. His early career was working on the Lloyd's trading floor and working with the FTSE small cap finance directors on investor relations. Mike's focus has always been on market cycles. He closed 80% of trades 2 hours before the US trade figures came out in 1987 and sold 80% of his dot-coms the first week, February of 2000. Well, it sounds like you have a heck of a timing system. Mike's chief strengths lie in the Fibonacci pattern, which I know well. I write about Anthony Fibonacci quite often. So I will give you the floor and mute myself. You have until 5 minutes before the hour when we start handing out our first batch of prizes. So you have the floor.
Thank you very much, John. Welcome, everybody. Good morning, good afternoon, depending on where you are. Yeah, I mean, just to carry on from John's introduction before I sort of dive into this, I'm primarily an investor and always have been since very early 80s. I started day trading in 2005 because A, I really enjoy day trading, but B, because if I'm spending so much time on looking at the bigger picture and plotting the markets, it made sense to me to use a part of my day to excuse me one second, to get in and out, to really exploit my account on day trading. And so when I started day trading in 2005, I actually started trading in the softs, in soybeans, and quickly moved on to oil. In 2006 and 7, oil was incredible. Even in the Euro session, you could make a day's money pretty much in the first sort of couple of hours of the day. So, yeah, I am totally sort of fixed on the US trading session. In actual fact, I have traded this morning, but it's rare for me to trade in Euro session. Anyway, let's get going. So what I'm going to talk to you about is I'm just going to give you a quick introduction into my system and show you a few pointers as to how I get in and out of these markets and show you a few of my trades. I'm just listening to John on his introduction about his projections for oil and even for today. I'm with you all the way that once we get, I think the oil is due a little bit more of a pullback, but I think once we hit some key pivots in this oil, yeah, I can see it getting through 120, 125, 150. Yeah, and that's going to cause a lot of problems to the economy. Anyway, let's get going. So like I said, I've been trading since 2005. On average, I take 300 to 500 pips a week on oil. I don't necessarily trade oil every day. I'm also going to talk to you about the Dow. Of all the indexes, I like the Dow because the daily range is so nice on that. It's more limited on the S&Ps and NASDAQ. So I like the volatility. As a day trader, I want the maximum volatility. So volatility in gold is way too low these days. It's a much, much thinner market anyway. So Trade Easy Way has been going since 2009. We're in the business of just giving you a simple system that you can use day in, day out. Do the same thing every day and expect the same results. I run a trading room, so the trading room opens at 9:20 Eastern time, 2:20 London time. Today's a Fed day anyway, so I suspended the room because it's a Fed day. It's traditionally very tricky. What I will be doing though is trading the actual Fed reaction. And then once the trading room closes, then the alert system kicks in. So quick disclaimer, you've got to trade with professional trade system. Otherwise, the potential for you to lose money and lose a lot of money is high. 70, 80+% of retail investors, traders lose money. So that's because the bulk of them don't have a plan, don't have a system. So this is purely educational. Key aspects of the system have been stripped out because it's taken me hundreds and hundreds of hours to develop this and refine it. And I do fine tune it and adapt it every now and again. Obviously, we've had a dramatic increase in volatility this year. So I've adapted it to fit that volatility. And let's move on. So why day trade? A lot of you, if you want to day trade, are going to do it for income. I do it for income and hedging. Particularly in a week that's just gone by, I've got some long positions that I want to take care of and I want to stay in. I've been highly selective this year, and I've deliberately traded a lot less this year on the investment side. I've done some very interesting bear raiding as well, which if we've got time, I'll talk about that as well. But the whole why day trade, you don't need a big account as long as you have a system and you can get consistency in your trading. You can start with a small account, $500–600, ideally more, but as long as you're trading in the correct position size, then you can accumulate. So day trading is great because you can use a lot of leverage once you're skilled and experienced, and then you can just close the whole book and then just manage your investments during and at the end of the day. All right, there is such a thing as a free trade. If we got time, I'll go into more detail about what I call a free trade. And that's basically using high leverage over a long period of time with low or zero risk. All right, facts. Before we dive into this, let's just go through a few facts. Markets move sideways 80% of the time. One of the reasons why I think a lot of people lose money in trading is because it is counterintuitive. And in terms of the level of discipline needed, somebody once told me a long, long time ago, you need the discipline of about 3 people to day trade. You've got to be very, very disciplined. And I've learned the hard way as well. In the early days, I had too many losing days, so I stopped what I was doing. Did hundreds of hours, many, many hours of back testing before I developed the system and refined it to the point where we are now. All right. So what do I like oil? I'm going to talk about Dow, like I said, I'm going to talk about Dow as well, but the reason why I like oil is because it's volatile. It's got a great daily range, but there's a fixed point in every single week, i.e. the oil invents, where you can really pin the price of oil down and then measure the reaction in the subsequent hours and days around invents to create an environment where you can have higher probability trades. So that's one of the reasons why I like oil. Oil, like any other market, can go through quiet periods and erratic periods. So like I said, I don't trade oil every single day. I trade it most days, but not every single day because I like the Dow so much anyway. So my system. So like I said, I'm going to give you a brief introduction to the system. And it's broken down into 3 key areas, which are obvious areas: brakes, pullbacks, and reversals. But particularly oil and you've got the events range, as I said. But with the Dow as well, you know, we are seeing some fantastic gaps. The bigger the gap intraday, the easier I find it to trade. So the kind of volatility we've got at the moment, with much wider gaps that you come into the open with, I personally found this environment much easier to trade, and I'll elaborate on that as we go through. So the basics, trading the right side of the gap is going to give you the trend of the day. We're based around, in terms of intraday trading, day trading, we are looking at the relationship of the prior day as well as drilling down from the big picture. So day trading for me is about, you know, the high and low of the previous day, whether or not we got momentum in the current trend, i.e. in the last week, very bearish, and are we going to hit a reversal? So 1 second, I'll just take a sip of drink. And the last one is very applicable to today, the data range. I'm going to show you an example of what I did last Friday on the CPI numbers on gold, and I'll talk to you about what I'm looking for on the Dow and oil post-Fed. So as far as it doesn't matter what type of trading you do, what type of system you do, the one thing that retail traders often lack is a map, is the prep. So I'm just going to spend a couple of slides talking to you about the prep for this current volatility. So this is, let me grab the pen. So here, so we wiggle up into this 35.5K, and then we had immediately on the back end of May and into June, we started to see this selling. So there's sell points here. So my question to you is, you know, how can you best trade that? How can you be prepped for this to capture some of these moves and to get the break? Ultimately, you know, we all want breaks. Breaks are where the money is. Breaks are where the advantage of being a day trader is. So how can you find them? Well, this is the map. So if you take that relatively flat 1 hour chart of the Dow and then fib it, plot it, or the best term I think is to map it. So if that's the previous week's high and low, and you come into the early part of the week on a sell, so at the back end of the prior week we saw some downward pressure anyway. The Monday opened right into this zone, and this is the crucial aspect of this. It's all about zoning in my book. That's the high and the low. This is the outer zone. This is fib levels. This is the 50%, which I know you're going to tell me is not a fib number, but hey, yeah, it's relevant. And this is the inner zone. So we hit the high of the outer zone literally to the pip. You know, these markets are random, so it's not often you can actually pinpoint levels on this, but this particular week was almost pip perfect. So the zone sold on the Monday. We had a move into the end of Monday and into Tuesday, and then we just flipped. But when we pulled back, we made a lower high, and subsequently, as the week unfolded, as you came into each day in this first week of June, you saw lower highs, and then ultimately on the Thursday, you have a lower close on the inner zone. So this is crucial. That should really get you excited. That should really keep you in the trade if you've mapped this out and you can see that kind of setup. So once you break that support, timber, just sit there, and we get to an extension level, we move sideways. Less experienced traders might even be trying to buy this, believe it or not. You ask any broker, the most common problem with retail traders is counter trend trading. So we drop, we move sideways overnight, we start closing lower, and then we spend the rest of that Friday even breaking the 161 extension. All right, so that's the map. Let's move on. How can you use that? This just pretty much, I'm just putting the system. So now you've got the map. I'm laying the setups over the map. So you've got the pullback, number 2. You actually get a reversal here off of a key level of support on the Tuesday, but then you get the lower highs, you get the pullback to the inner zone, you get the lower close under the on the outside of the inner zone, and then you break. Okay, so you go 2, 3, 2, 1 as you wave down. How can you use that intraday? How's that relevant? Okay, Mike, you've mapped that out. Now what do I do with it? Moving on. So this is the high and low on the 8th of June. So typically, well, I say typically, every day we will look at the high and the low, see how the market. So you already had significant sell on the 8th. So when you come into the market on the 9th, we pull back into the drop zone. We close lower. Now we actually open. It was a tricky open, unless you're really tuned into this, because on this day you get a huge move right into the low of the inner zone. So you get things, the first 15, 30, 45 minutes, the market sits right up, and then immediately, so you get a 1, 2, 3 wave back. So that's tricky, unless, like I said, unless you're really tuned into it, unless you're really prepped and armed for that. You could get distracted by this big bullish move. But as you come into the back end of the day, you've got a lower low, a lower high, and that is the point, one of the most crucial points of the day. I think it's probably about a couple of hours before the close. You lower high, you close under the previous day's low at this point here. That's the signal. That's the point where one of the questions that should be in your head is, when do you when do you go for a smaller move, and when do you go for a bigger move, or stay in the trade? If you are breaking on the upside or breaking on the downside, I would suggest you stay in the trade at least into the close. Good question. What's the volume like in the Dow? Volume has been incredibly good. Now, that's the one thing that's missing from this chart. It's a good question, because the only indicator, you can see there's no indicator on these charts. The only indicator I do normally use, and I've taken it off just for the purpose of this slide, is volume. I'm not interested in any, as a momentum trader, I'm not interested in any other indicators. I think some of them are useful. I'm not saying don't use them. What I am saying is I'm totally fixed on the price points and the reaction to the previous day's range. to look for the system to kick in and tell me what the most likely point is where I can get a move or preferably a break out of this market. So volume is the lifeblood of any market, as and I'm sure you know only too well, but so that's why I don't use a lot of indicators. Moving on, I just thought I'd make the point to emphasize this what I've talked about on the back end of May, first week in June. So this is the 1 hour for this week mapped to the prior week. And I mean, John started off by saying that he thought we were in for a bounce on the Dow. And this map was already suggesting that the bounce is potentially underway, because this is the previous week's high, previous week's high. We've gapped down at the weekend open. We sold at the 127. We came up down the 161 and then closed and then put in a buy signal on the 161 extension, minus 161. So as long as we don't close underneath here, we could potentially climb back and go and close that gap. I'm going to talk about gaps in a minute, because I think gaps are, like I said, I think gaps in my book make trading a lot easier. So if John and I are correct, we're potentially going to see a head and shoulders here, the neckline's here. This is going to be a crucial pivot. And then we could, in theory, wind up and close that gap. Now, don't get set on the fact that John and I have talked about the potential push higher. Be fixed on what the reaction is to the data, to the Fed. It's not about what I think or what I'm saying right now. It's about what the reaction is. And that's where less experienced traders fall over, because they hear people like us talk about potential reversal and getting long. And yet, if the market doesn't deliver it, you're going to get your account chopped up and potentially even blow it up. So you've got to be fixed on what the market is doing. And I'll come on to that in a minute. I'll show you some examples. So just a few quick examples of trades I've done. This is the Dow. This is the previous day's high and low. We've got an extension reversal set up here. At the point in which I took this screenshot, I got 171 pips on the upside. That blue line is my entry. So I suspect this is the back end of May as we ran up to the breakdown area of early June. So I just picked the slides that just grabbed a few screenshots that can make the point. So let's look at a more obvious pullback. So that's a reversal. This is a pullback. So you're trading the right side of the gap. There's the prior day's cash close. There's the close on Friday. So you're above two gaps. You get a decent move in the Euro session. In fact, so we open here and we pull right back in towards this support found in the Euro session. I bought that support and currently showing 95 pips up on that one. Potentially looking for 35 and a half. Can't remember if I achieved that on that day or not. But anyway, I'm going to move on and talk about oil in a second. Here's a recent oil trade. I actually shorted oil yesterday. I'll talk about why I shorted oil yesterday intraday, not a long-term short, of course. Previous day's high and low. There's the gap. We come into the. We have a decent down move, decent downdraft of at least 100 pips in the oil. We pull back. We wing it down. You can see that blue line is the entry of my live account. My live account shows it on the screen. Now I sit through quite a heavy pullback on this. I sit through a good 70. Intraday with futures market. That's this is my spread betting account. But I've got 5 accounts in all for various reasons. It's my spread betting account. which I use in the trading room because it just makes life easier. And then, so we get a 1, 2, 3 wave. We fall back into the previous day's high. That's a crucial pivot point. My stop's out of trouble. And then I've got 170 pips as we look as if we're potentially heading back for the gap. In fact, I suspect I actually took this off here. Can't remember. Anyway, it's a good move. 170 pips on leverage is nice. Now I'm just going to show you, I'm going to talk about switching subjects a bit now. I'm going to talk about gold. I start off by saying I'm an investor. So as an investor, particularly in miners, in an inflation super cycle, commodity super cycle, which I started calling in March 2020. There are videos on YouTube of me talking about natural gas, buying natural gas in March 2020. So big move, fall back into the ambush zone, and we start to wave up. Get a 2070 move up here. So I was buying, suggesting to everyone that would listen that this is a buy area. And I traded a few times on small with low leverage. It got stopped out, so it's very choppy. But last Friday, so I sat back, left it alone, and then I did this. I traded, and this is relevant for today. This is the CPI move, the core inflation move last Friday. There's your direction. So this is what we need to look for. If the Dow is going to pick up and close that gap today, this is what you need to look for. If you've got a directional move post-Fed, and particularly after the press conference has started, and you get either, now in the case of commodities tend to do 100% pullbacks. Dow tends to do a 50%, sometimes a 60% pullback. So oil tends to do a full pullback, oil and gold, and the Dow tends to do 50, 61%. That's my entry at 1830. That's my target. Now this thing actually goes to 1875, but my system told me that was an extension. So I got out at the 1860. At the point in which I've shown you this slide, I got $18.50 move off the back of that 1830 entry. So it's direction, pullback, move. And the move is normally, and in fact, this is what's happened here. We've got this initial range is it's about $20. So if you add $20 to this high, yeah, you get 70, 1870. And we actually went to 1875, I think. So I got out at I think that was a 161 extension, I can't remember. Happy to do that because, like I said, markets move sideways 80% of the time. So if you've got an extension on a three-wave move, then I'm happy. I'm out. In actual fact, I traded, having got out of this, I think I traded Dow this day, not oil, can't remember. Anyway, let's show you some more. Let's go through some more details because I want to get on to gaps. I haven't got that much time actually, right, too many slides. Gaps. Let's talk about gaps. They're magnets, absolute magnets. It's been a much, much bigger theme in my trading through all this volatility. I posted this in the public domain on the 7th of December last year. And what I was highlighting was this gap here and this gap here. And we've literally yesterday just filled gap 2. When I posted this, I got a lot of abuse actually from a few avid Bitcoin followers. They thought I was talking absolute rubbish. and they kept telling me Bitcoin was going to go to 100K. I think we did pull back here into January, but we subsequently have closed gap number 1, and we've just literally in the last 24 hours closed gap number 2. And I think last I looked, I think we're about 23,000. So gaps are crucial. How do you use them? I must gallop on. These are gaps in the Dow since the 20th. So we closed this gap on the weekend breakdown, and now we're potentially reversing and about to go back and find 31.5. No idea what the market's doing at the moment, but I will leave it. I'm not going to touch it till Fed anyway. Okay, so that's how a couple of examples of how gaps can work on bigger timescales. How can they work on smaller timescales? This was the Dow yesterday. So this gap on the Tuesday close was roughly 30,550. It was a floor in the Euro session, and so overnight in the Asian session, held in the Euro session, broke down in the open, and then you got 2 shots at the short. So you're trading the right side of the trend in intra-week timeframes, as obviously in the bigger time frames, the daily as well. So you're trading the right side of the trend if you are fading or shorting, selling the gap. The first leg gets you 250, the second leg gets you 350. I always find 90 minutes into the session is quite often where the moves come from. Something about, it's a fib number, isn't it? It's quite something about 90 minutes that is a very, very common time. If you are going to get a real trend move, watch out for that hour and a half. If you assume you've missed the open, because I mean the lower high and the breakdown at the open was there to be seen, but if you missed it, doesn't matter. You get a couple of shots at it, and then you get a reversal. That low was the intra-week minus 161 extension, right on the pip, right on the button. So this system, the advantages are it's very simple. It's easy to map out every day, every week. When you've got volatility, when you've got the volume in the markets, it can be pip perfect. I mean, look at this gap hardly gets breached. So you could sell right into the gap with a stop above that noise. So let's march on. The point is that all this is ready and mapped out by me for the guys that are in my trading room. So they're coming into the trading room. They know what to expect because they've been on the program. They know exactly how my charts are laid out, and they know what I'm going to be telling them. So they just like to trade as a team and mark these spots out and get in on these trades. So let's talk about oil, because oil's been fantastic. Obviously, in this kind of volatility, as with the Dow, gaps are really important. Partial or 100% gap fills are great. Invent range. Let's talk about the invent range and the invent fade and break. This is a 3-wave invent move. So I suggest you always go into an invent move flat. Clean your account out. Don't attempt to preempt what you think is going to happen in the Fed today. Don't attempt to preempt what's going to happen in oil invents, because you never know. So the way to trade any data move, particularly the bigger data moves, is to look for the direction like I said to you earlier, oil tends to do a 100% pullback. This takes a couple of hours to pull back. So if you want to, and there's a gap there. So it's common for gap fills to be overshot. This gap fill gets closed and overshot, and then you get the directions. So you short into the gap. So this, you can tell this is a while back because it's price is miles away. And then you go back to support and some. Let's look at a more recent shot. The trading rules, yeah. Let's go. This was this is all yesterday. There's the extension. Look at the volumes. You can see this is my normal chart. I've got a moving average on the volume. So we see this pink range is the invent range from last week. So into the sort of 8 o'clock Eastern time, New York time, Europeans push it up. US come to their desk, they buy the invent high, they take it to an extension. So what a lovely three-way move. And almost pit perfect off of the high of the invent range. So again, this is a key part of the system. You don't have to buy the high. If you wanted to wait for confirmation, you got to close above the invent range. You get a chance to pull back close to 900, 119, and then you go to $121. Clearly, the volume, you go up on lower volume. If you go up on lower volume, that is quite clearly a profit level, and a lot of traders just got out. The volume, we went up on lower volume, so do not sit in that. I suggest, one of the rules is, you asked me about rules, well, one of the rules is if you go up and hit your target, get out. Don't sit there, expecting this to go to the moon. That's your target. So previous day's high, previous day's low, invent range worked. You get you bobble around, but you close, you hold the previous day's high. Any market that holds the previous day's high, get long, stay long. Any market that closes under the previous day's low, and that Tuesday night we did flap around on the Dow, but get short, stay short, if it is closing underneath. All right, so clearly a short. I need to be very quick here. Quick point, don't pay attention to the invents. Normally, if there's a build up in the invents, the price of oil comes down. On this, there's a build up in invents, and the oil went from 97 to 113. So don't waste time trying to work out what's happening in the news and the data, because it's just not relevant. Right, let's go to some, let's talk about, let me just quickly call up the chart. Let's get the oil on here. Yeah, Dow's kicked off well. Let's get the invent range up. Right, this is oil on with the last two invent ranges. This is my final point. So this was the invent range from the, I think, yeah, it was a day off, wasn't it? Thursday, the 2nd of June was the invents. Friday, we pulled back to the invent range on the next day. So if you miss a move in the oil invents, and this is not, I don't think that was a particularly easy day to trade because the bulk of the move was already over by the time the invents came out. It pulls right back into the invent range the next day. So you get an A, B, B wave right into the mid to lower level of the invent range, and you pop up to 119. On this day, the floor of the invent range hold, which is an ideal place to get in, and then it goes and finds 111.46. You come in and out the invent range here. You test the high of the invent range on that low, which is, I think, the slide we've just looked at, and then you go close to the recent high, and then you get a significant pullback. Okay, so that was the invent range from 2 weeks back. This is last week's invent range. So because of the volatility, we have been sort of chopping in and out of this invent range. So the low of this week was on the invent range from 2 weeks back. We held last week's invent range and then went back to the highs. So this was a sweet move if you'd have had the all those levels worked out. So the rules of what I've not talked about, I said quite early in the presentation, what I've not done is given you the intricate detail and the entries and exits system of this system. So we have what's called an anchor chart, which is the basis of the relationship of the prior day, which is a bigger time frame. And then we drill down to fine tune the pullbacks or the breaks and reversals in a smaller time frame with specific entry levels. Now these entry levels are normally within a sort of 20, 30 pip precision point. So on a good volatile day, we can pretty much get it pip perfect. On a less volatile day, sometimes it can take a second entry. There are normally two levels to look for in the system. If the first level doesn't work, then I'll sit back and look for the second level. If that doesn't work, then I definitely close the books. I stop trading. Fed days in the open, I normally don't trade anyway, because they can be, a typical Fed day is normally very tricky at the open. But if it works as I've described, we should get some interesting moves and directional moves after the announcement. So the exit strategy is clearly part of the system. I showed you a very specific exit level on that gold trade I took. It was $15 shy of the day's high, but I don't care. I'm out. Bearing in mind that that was a gold trade, and I trade Dow and oil anyway. Yeah, so the rules of the system: 2 stop outs, get out, close your system. I tend to go in half size on some of the trades where there's 2 options rather than 1, and I'll add to a winning position. And obviously, as I said, I cut the losers short. So I'll be adding to winning positions if I do go in at half size initially. So I do end up with a full size. Sometimes I even end up with a double size if I add up on the way up. If it's really trending well, and I can add up and pull backs. The system's mapped out. Let me just refer to a couple of notes here. The other, just a reminder, go into data flat. Avoid Fed days until the announcement's out. Position size is crucial. Don't vary your position size. 2 stop outs, back off. Have an exit strategy and stick to it. But primarily, if you're trading in this kind of volatility and you've got gaps, the system is very, very good. The strength of the system is in plotting gaps. So it's about the entry points come from that plot. in relation to the gap. So the trading room that I run is open 5 days a week, apart from Fed days. Once the trading room normally opens for about 45, 50 plus minutes, sometimes longer, sometimes shorter if we've made a move in the opening 15, 40 minutes. And then we're waiting to stalk another move. Once before the trading room is closed, the main thing that happens is I give a debrief on exactly what I'm looking for the rest of the day. So I'll plot specific levels I'm looking for as the day unfolds. And for example, on that June 9th, the crucial point of the day was that last 120 minutes. So if that's the case, I'll plot the anchor chart out and give everybody levels that I'm watching for, and then send out alerts as well. So by coming into the trading room, you are much more able to stick to the rules. You are seeing how the system works firsthand. I'm giving you running commentary. We're looking at least oil and Dow. We do, if the Dow for whatever reason is not as clean as the NASDAQ, I do sometimes jump to the NASDAQ. You can apply the system to stocks. For those of you who day trade or want to day trade stocks, the NASDAQ pump and dump system works with this as well. But I haven't got into that because there's just no time. That's a whole lengthy angle. But to be honest, as I'm an investor in stocks and a bear raider in certain sectors, I find unless you're totally focused on pump and dump stocks, NASDAQ stocks, I don't think it's worth doing it. So I'm totally focused on oil and Dow, so I don't focus on NASDAQ stocks. But I have done in the past, and it can be good fun. I find you get to know the character of the Dow and oil really in great depth. And if you're doing pump and dump, I found it a little bit more hit and miss, but maybe you're more tuned into that, and that would work for you. But it didn't work as well for me, so that's why I backed off and pump and dump on stocks and day trading stocks. Okay, so any other questions? Let's just take a look at how oil is open today. The 10-minute chart. So I shorted. Actually, I took a screenshot this morning's oil. I haven't put it in those slides. Yeah, I shorted this resistance up here. Actually, no. I tell you what I did. We did a drop and pullback on the oil, and so I took the fade of the gap. We've seen this big sell-off, well, this significant pullback, I should say, and the Euro session performance of oil was lower highs, lower lows. We broke down under the gap, so I shorted into the gap with a stop above resistance and took that initial move down right back into just into that 500, and then took it off. So that was my this morning slice of the oil market, and it's pretty sloppy here anyway. One of the reasons why it's sloppy is because we've got invents today. So invents, the run up to invents is normally a good day not to trade oil. So that's why it's good to focus on different markets like Dow, NASDAQ, and sometimes gold. Okay, so once we get invents, so we've got a double whammy with oil today. We've got invents and Fed. So what I would do with invents is, let's look at the price of oil as we got it now. I think I would still say it's all going to pivot around, first and foremost, number one, it's going to be the invent range. So I'm going to be marking off the invent range. color banding it and see if we can sort of break up and pull back, break down and pull back. Yeah, link to the sales page. Okay, and that's what I'll be doing with the. So here's the link to the offer that I'm offering you guys today. Let me just punch this in the room. So what I'm very tight on this, the way I price the program, because it's a lot of my time. I give a lot of commitment to running the program. It's a very intensive program, so I don't have a habit of discounting it. So this is a rare occasion for me to drop 25% off of this. What I'm doing is I'm prepared to give you an extra month in the trading room. So that represents the, a 25% discount off of the price. So in the system, and it's all mapped out here, there's the PayPal button box. If any of you want to have a quick chat about the system and what's involved with it and what you can expect in the program and what you can expect in my training room, by all means, drop me a line from the website or on the WhatsApp. And so I'll just quickly go through the program. I've got a couple of minutes spare, I think. This is the layout of the program. So we talk about what's called gap and go. We talk about the open breakout setup, the big reload. I haven't got time to go into that. Intraday reversals. We saw intraday reversal in oil. That sell at the high yesterday was intraday reversal, as I described off of the chart. So it's a 4.5 hour program. We do simulated trading at the end. You've got check sheets, rule sheets, and then you're straight into the trading room, and then you get the access to the alert room. Okay, I do very detailed prep sessions on Mondays, and I do training sessions at least once a week, sometimes once every second week, on very specifics, on things like advanced Fibonacci, advanced entry systems and exit strategies, to do with how to gauge if you've got a break, and how to prep and manage your risk for those breakout patterns.
Okay, Mike, we're just about out of time.
Yeah, that's fine. Hi, John. Yeah, I finished up anyway. So
okay, great.
There's the link, guys.
To take advantage of Mike's offer, click on the link in the chat box on the right. It says Mad Hedge Brilliant Offer. Can't beat that. Mike, thank you very much for joining us from the other side of the world. You have a nice summer. And again, excellent presentation. I look forward to working with you in the future.
Thank you very much, John, and thank you for inviting me.